It's an urgent warning. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, every American household is at risk, and the experts are warning you may need to dump this now. We'll show you what the experts are saying every American household needs to get rid of, and we'll make the case why this time they could be wrong. Plus, we have a sponsor for today's show. I'd like to welcome Connect M Technology Solutions to the show. You can find them on the NASDAQ under symbol CNTM. And this is one you want to put on your hot list because they're a tech company focused on the electrification economy. But the big news is less than 2 weeks ago, insiders were buying a massive amount of shares. And when they're buying, it means they know that there's big news coming and the stock is likely to shoot higher. We'll make the case why their stock's going to go up and why we think it could go up as much as 76%. Again, check them out on the NASDAQ under symbol CNTM. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now, let's head over to Bloomberg, where we picked today's story up with a headline as the dollar is close to erasing 2024 gains as more Fed cuts loom. And dollars is something that every American household has and could be just in physical cash, but mostly in savings, such as in money markets and CDs. But the experts are starting to warn that the dollar is about to significantly weaken in value. And if you've been wondering what's been driving the equity markets, why money's flowing into bonds and commodities, well, it has everything to do with the fact that the dollar could get substantially weaker here. We'll show you why the experts are making that case and also show you why this time they might actually be wrong. The U.S. dollar has weakened notably since late July as the market pivoted to the prospect of more aggressive easing by the FOMC. We see the dollar vulnerable to weakness going forward, although on a more modest scale, and this is some concern because a lot of people don't understand the relationship between the federal funds rate and the U.S. dollar. Well, the problem is there isn't actually a direct relationship, but there's this broad view supported by Wall Street that when a central bank eases by lowering interest rates or doing quantitative easing, that somehow it causes the currency to weaken and loosen in value. This is a big issue that we saw going on in China as they wanted to cut rates and stimulate. It caused the yuan to tumble in value. Now we're seeing the same setup here for the US dollar, but the problem is there is a case where it may not actually go down. But let's take a look at the relationship here between the federal funds rate in blue and the nominal broad US dollar index, because we can see cases going into the global financial crisis where the Fed was aggressively cutting, and well, it did actually lead to a weaker dollar. In fact, we can go back and see that the dollar was actually weakening ahead of the Fed rate cut. In some sense, perhaps the market was anticipating that the Federal Reserve was, well, making a huge policy mistake. But we can go forward to the beginning stages of the pandemic where the Fed was cutting before we even knew there was a pandemic, and that actually sent the dollar up a little bit before it surged higher, the same thing that happened during the global financial crisis. So what is the likely outcome here? Is the dollar going to weaken or is it going to go higher? The question is, what is the actual relationship? And that has everything to do with the financial system. Because when the Fed cuts rates, it's believed that we actually see more dollars created, even though the Fed actually has no ability to create and destroy currency. But when we take a look at the commercial industrial lending data, they're shown in blue on a year-over-year rate of change, it starts to make sense of what we're seeing in the dollar because commercial banks are the only institutions that can create money, and they do so when they originate new loans. And here we can go back to the lead of the global financial crisis where we see that commercial industrial lending was running at a very strong clip, and that actually sent the dollar lower because the commercial banks were creating lots of dollars. We actually see that here again around 2015, 2016, where a long stretch of commercial industrial lending is finally starting to lead to a weaker dollar, as we see here coming into 2017 and 2018. When we see the pandemic, there's a flight to safety. The same thing that happened around 2009 has sent the dollar higher. This time, the experts are saying the dollar is likely to weaken. When we look at the lending data, it becomes very clear. There isn't a whole lot of lending going on. In fact, it's sitting near the zero line, suggesting that there isn't a lot of money created. But again, it's the popular belief that at first the dollar weakens. And if we head into a crisis, well, then it tends to go vertical, as you've seen before. Goldman Sachs last week lowered its forecast for the dollar against a wide range of currencies, indicating they believe the dollar is headed lower. JP Morgan Chase strategists said they're keeping dollar exposure, quote, light and net neutral until additional U.S. labor market data gives us better clarity on the Fed's path. Now, why would the labor market matter here? Well, it's really simple, because if the labor market was strong, then it would suggest that consumers are going to go out and borrow and spend, then businesses are going to go out and borrow and spend, and there's going to be a lot of dollars created. But if the labor market weakens, well, watch out. It could send the dollar screaming higher. And Fed Chair Jerome Powell said markets should not assume 50 basis points will be the new pace of cuts, but reinforce that officials will continue, as always, to monitor incoming economic data to determine future moves. The problem is when the Fed actually starts making big cuts, the next ones aren't small. They usually start with 50, and then it continues at least that pace, because they know the labor market's falling apart, even though the data doesn't quite suggest it yet. Short-dated treasuries gained as bond prices rallied as traders added to bets on more easing, taking two-year yield to the lowest level since late 2022, and further steepening of the curve as investors believe the Fed is going to cut and send bond prices higher. But something else we think is headed higher is Connect M Technology Solutions stock. Again, check them out on the NASDAQ and the symbol CNTM. And just less than 2 weeks ago, the insiders were buying stock right here. You can see this red line. This is a 6-month volume profile. You can see a stock trading right above it. Why is it looking up here to $2? I'll show you why at the end of the show. But right now you're seeing a setup where the stock is making a series of higher lows and is about to break out. The U.S. mortgage rates, though, as we talk about lending now, as interest rates go down, this is critical because we see rates are falling, triggering a big wave of refinancing. And on the forefront, that might sound like, well, that's a lot of dollars being created. The problem is it's refinancing. It's not new money. What we need to see is new loans being created where there's demand in the economy from consumers and businesses that are looking to buy things, spend money, expand their warehousing, expand their factories, and generally do more consuming. We're not seeing that here. What we're actually seeing is consumers are cash strapped. And applications to refinance mortgages surged for a second week as more Americans capitalized on the cheapest borrowing costs in 2 years. And that helped boost the group's home purchase applications index by 1.4% last week to the highest level since early February. But that's not a big deal. You start thinking about that, and it's pretty small. You think 1.4%, it's nice, and that's new money being created. But the real issue here is what we see is the refinancing index jumped 20.3%. And that's not new money being created. That's someone going to the bank and saying, look, I'd like to lower the interest rate on this existing loan. Yes, there's a new loan created, but the old loan's paid off. So there isn't net money created in the system. This is all being done because consumers are cash strapped. And when you start putting that in perspective against the labor market, you start to realize why the Fed panicked with a 50 basis point cut. And while in the short term, the dollar may weaken as market expectations drive it lower, but if the labor market falls apart, look to buy as many dollars as you can get your hands on. Because when we take a look at the consumer price index shown in blue against total income or average hourly earnings multiplied by average weekly hours of production of non-supervisory employees, that's shown in red, both on a year-over-year rate of change. The notion here is that consumers are ahead. You see households, there should be ahead of inflation. The problem is, while the data suggests that, what it doesn't take into account is the years that households were behind inflation, borrowed a lot of money, and there are things in the CPI that aren't being reflected here to suggest that American households are desperately running out of money. And we have the evidence of that as we look at the personal savings rate, which is being drained to one of the nearly lowest levels in history. And what we can see is that when incomes go down, as we see here in red, keeping that total compensation number there, eventually households wake up to the reality that they need to cut spending, they need to boost their savings rate, and that starts to make sense of why we're seeing a bunch of refinances and not a bunch of people moving, because they're trying to increase their cash flow by any amount. That's where we're state of the U.S. economy is right now, where consumers are absolutely cash strapped. And when we look to the new housing data, we should see this flurry of demand because rates have gone down, and the expectation that rates are going to go lower should be bringing home buyers out. The problem is that number is falling as well. As U.S. new home sales fell in August as buyers awaited lower rates, get this, contract signings dropped 4.7%. This was after a big jump in July, now sensing that perhaps it's not lower rates that are the issue. And it makes perfect sense because we heard not too long ago, in fact, in yesterday's show from the conference board, that consumers were starting to worry about their job. And what do people do when they're worrying about their job? I'll tell you what they don't do. Let's go buy a new house. The median sales price, meantime, decreased 4.6% from a year earlier to $420,600, marking the seventh straight month of annual price declines, extending what was already the longest streak since 2009, because builders have something that the resale market doesn't have, and that's margin to lower their price. Look for this to put pressure on the resale market. But look at this. It's also a matter of fact that wealthier people aren't buying, as it mainly affected fewer sales of homes priced above $500,000. Now we're at an economy where even wealthier people are starting to realize that things are slowing down, and they're not looking to move either. Again, you start looking out and you start to realize the money creation engine of the economy, which is why we looked at that commercial industrial lending early in the show, because it's virtually at zero, suggesting there aren't a lot of dollars being created here, but it's still in the short term could lead to a weaker dollar. Again, opportunity to reposition here, but over the longer haul, if we have a financial crisis, well, you want to hold on as many dollars as you can, because falling borrowing costs should ease some of the affordability problems. Key word, should ease, but it's not, that's plaguing the housing industry. Builders, including Lennar, have stoked demand by heavily deploying sales incentives. Again, the resale market can't compete, so just buying down mortgage rates, which just isn't working, and is partly coming at the expense of gross profit margins. But again, what we see here is builders have too much inventory. They're competing with the resale market, and they've got the advantage. Eventually, we're going to see people that are forced to sell their homes because they've moved. They need the dollars. They need to stop the bleeding on their old home, and prices are going to start coming down. But will, of course, the Fed save the day with a cut in the funds rate? Well, data suggests, well, we don't know, because it goes either one of two directions. Either the Fed's cutting rates, and here you see new privately owned housing starts in red, that goes down, or perhaps it's like the dot-com bubble where lower rates did actually stoke demand. Of course, we know this had to do a lot with the fact that baby boomers were demanding housing, but by the global financial crisis, nobody was looking to demand anything, as Fed rate cuts sent new housing starts tumbling even more. But going into the pandemic, well, that did the magic once again. The question is now, will this downward trend in housing actually be reversed by lower interest rates, or are we in an economy now where consumers just can't afford these higher prices, cannot afford these homes? I think it's the latter here, and the evidence is mounting as we start to eventually look around the global economy. Now remember, we just talked about the U.S. manufacturing sector. We've talked about China's, Europe's, and what do we see? Demand is weakening, production is too high, jobs are going to be lost, and these aren't the cases where you see people want to buy a house. And builders in August made notable progress in selling off inventory, with the number of completed homes sold reaching the second highest level since the end of 2006, again making the same mistake they did going into the global financial crisis. However, inventory is still robust, with over 467,000 homes available for sale, near the most since the bloated days of the Great Recession. Again, nobody believes housing prices can come down, but when you factor the inventory levels, when you factor the fact that American households are running out of money, their savings rates are ultra low, and that jobs are about to be lost in a major way, you start to get the picture of why housing isn't going to be driving the creation of money. And without housing, you don't get all the other associated spending that comes with it. And all that points to is the fact that the dollar may not weaken much, could just be a short-term play before it goes screaming higher. When we talk about how builders compete with the resale market, here you can see new one-family homes sold in green going higher against existing home sales and pending home sales, that in orange and red tumbling down, as of course builders have the margin, the resale market doesn't. But some believe online holiday spending is projected to surge by 8.4%. That could be the most since 2021, and that would come on the backs of discounts and other forms of price drops. The issue here is consumers don't have the money. They don't even have the credit to do this. Can it happen? I don't think so. But if it does, it could spur the mythical soft landing the Fed's hoping to achieve. And while the firm is projecting strong online spending this holiday, U.S. shoppers remain cautious. Consumer confidence unexpectedly fell in September by the most in 3 years amid concerns about jobs in the economy. And if you're concerned about your job, if you're going to work and seeing that there's not a lot of new orders, and you're seeing the existing order book go away, and you're seeing more and more employees stand around, well, you're not going to go out and spend big on the holiday season, because you're going to be concerned if at best your hours are getting cut, and in the worst case scenario, you're going to lose their job. But here we turn now over back to Germany, where we see Volkswagen squaring off with the union over German plant closures, and this is only the beginning of what we're going to see in the global manufacturing sector as VW could force through decision on plant closures this year, paving the way for more than 15,000 job cuts. Of course, when they hit the unemployment line, demand is going to go away, and as we look around the world, we're seeing that here in the U.S. as well. Consumers completely cash-strapped, and we get that data from Morgan Stanley as we see they've downgraded GM, Ford, and other auto companies on Chinese supply. But here's a big one: rising delinquency. So when you look at the economy and you start to think about a soft landing or consumer demand, well, one place you don't see that it happen when you see rising delinquencies, because what it says is households are out of money, and that starts to make sense of why they're refining here, because any sort of increase in their household cash flow is critical. But let's take a look at what Morgan Stanley had to say, because credit losses and delinquencies continue to lead the trend for less than prime customers. Meanwhile, China, they're seeing profits flipping to losses as the country is producing nearly 9 million more units in sales locally. And of course, the rest of the world is trying to avoid them dumping that on their market. But look at this. Although subprime defaults are lower in 2023 compared to 2022, prime defaults are increasing as well, making all the evidence we need to see that in the short term, the dollar could weaken and that perhaps households could benefit from reposition. But then watch out. If the labor market goes, we're in an all-out financial crisis. And at that point, you want to hang on to as many dollars as you can. But one place you might look to reposition, and that is the stock for our sponsor of today's show, Connect M Technology Solutions. Again, you can find them on the NASDAQ under symbol CNTM. Everything you need to know in the pinned comment and description below. They are a smarter way to net zero. And their mission is energy efficiency, electrification, and decarbonation, as they believe everyone deserves affordable access to clean, reliable energy. Their mission is to electrify homes, businesses, and transportation to achieve a better quality of life, lower energy bills, and reverse the effects of climate change for a more sustainable future. And their energy intelligence network, well, that is key to the success for Connect M Technology Solutions, because when we talk about companies today, it's all about the data. And there's one thing they've got, and that's data. At Connect M, we power the future of electrification economy through our energy intelligence network, enabling OEMs, third-party service providers, and consumers to achieve decarbonization and net zero goals. Our all-for-one technology platform monitors and manages electrified assets through their entire life cycle, collecting valuable anonymized performance data. The data refines our artificial intelligence models and consistently improves the performance of our network. Data collected from residential users, service providers, and OEMs fuels a data-driven intelligence loop. This positions Connect M as a leader in electrification solutions, enabling the company to report on tangible and measurable sustainable impact of devices operating on its network. They currently serve over 50,000 customers and manage more than 100,000 in electrified devices. Their solutions are focused on the residential, commercial, transportation, and OEM sectors of the economy, and they have a large addressable market of $2 trillion in U.S. residential and commercial energy expenditure. An AI-enabled energy intelligence network platform, a proven platform with over 66,000 customers and 25 white-label OEM integrations. They're asset light and capital efficient with a potential high return on invested capital while ensuring organic growth, and they've been named in Inc.'s 5,000 as America's fastest growing private companies. And their Connect M platform is a differentiated, all-inclusive smart solution that links the customer to a single point of contact in the Connect M platform. The value proposition is a 40% plus cost savings, unified interface for connected operation, data analytics, and AI optimized energy use and equipment use, and a 75+% reduction in carbon footprint. And they've got a white label network integration with market leading OEMs and service providers that puts Connect M in between home building electrification, fleet services, and service providers to OEMs through their IoT platform, command center, conductivity, business solutions, intelligent edge, and AI ML in the part of their central hub. And they've got a proven platform with 10 plus patents granted, scalability, reliability, rigorous security, and they support multiple asset classes. And they just recently published an impact scorecard for the 6 months ended June 30th of 2024. They've got 87 gigawatt hours of electrification that's increased 200%, over 61,000 metric tons of CO2 sequestered, and 6.6 million gallons of fossil fuel displaced. And they've successfully eliminated $7.5 million in debt, reaching the halfway mark to the debt to equity conversion. And here's the great part about this. They're continuing to convert their debt to equity. But here's the big part. We talk about the $2 per share target. Well, it has everything to do with the transaction executes on the previously announced approval from the company's board of directors to convert up to $15 million of the company's outstanding debt to common equity, valued at $2 a share, putting some big upside potential in the stock. And this is one of the reasons why we see the executives come in and buy. And here you can see on September 12th, a purchase of 30,000 shares. Here again, another purchase of over 18,000 shares on the 12th and 13th. And you can check these out. These are both executives of the company. And now let's come back to that chart where we see a series of higher lows being formed here in the chart, suggesting it's about to break out. We see that upside target is $2 from the fact that we may see sellers of those who are holding that debt that got converted to equity and may need some cash. But you notice right now it's sitting right above its 6-month volume profile, looking to break out, potentially giving you the opportunity to make a massive return on Connect M Technology Solutions. Again, you can find them on the NASDAQ under symbol CNTM. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.